Before we start looking at income that an individual might receive from investments like bank accounts and shares, we will cover what a basic income tax computation looks like. You can then see how the different types of income fit into that computation. An income tax computation starts with splitting income into three categories: non-savings income, savings income, and dividend income. We show these as separate columns to which we allocate the different types of income someone might have. The reason we need to keep income separated in this way is that there are different rules that apply to how the income types are taxed and different rates that apply. One of the types of income that an individual might receive in the year is investment income, which can be split further between savings and dividend income. Savings income would include any forms of interest received, including interest received from bank or building societies, or companies. Investment income is assessed on the received basis, so rather than what is due for a period, we only take into account the amounts actually received during the tax year. There are a few sources of interest where tax is deducted at source, meaning that some tax is deducted and passed on to HMRC before the taxpayer receives the money, but these are not examinable at the taxation level. And so for the purposes of the taxation exam, we will treat all interest received as the full taxable amount, without the taxpayer having yet paid any income tax at all. If someone has savings income, we will include the amount received in the year on one line in the income tax computation in the column headed up Savings Income. If someone has more than one source of savings income, you can show it on separate lines or add them together and just put one line in. If you're just putting the total into the computation, then I would recommend you do a note underneath the pro forma to show your marker how you arrived at the total figure. This helps in situations where you've made an error in your calculation somewhere, as the marker can more easily follow what you've done and may be able to give you partial credit. When we come to calculate our end-of-year tax position, there is a personal savings allowance. This allowance is £1,000 for a basic rate taxpayer, £500 for a higher rate taxpayer, and £0 for an additional rate taxpayer. Despite being named an allowance, it's really an amount of savings income which the individual can earn in the tax year but pay no tax on at all. In fact, the allowance operates more like a tax band, as it forms part of the basic rate band, as we'll consider further in a later session. There is an accrued income scheme in place for you to be aware of. This will only be examined in relation to government securities, also known as gilts, which are exempt for capital gains tax purposes. The scheme requires the holder of a gilt to include as income any interest which they would be entitled to if they continued to hold the gilt, but which they will not receive because they have sold the gilt before the next payment date. Let's demonstrate this with an example. Peter buys gilts with a nominal value of £100,000 on the 1st of July for £120,000, which pay interest at the rate of 3% per annum. Interest is paid half yearly on the 30th of June and 31st of December based on the nominal value. Peter sells the gilts to Ruth on the 30th of November for £121,250, including accrued interest. At the date of sale, the 30th of November, interest has accrued on the gilts of £1,250, being £100,000 multiplied by 3% multiplied by 5/12. Peter will include this as income for the tax year, even though he will not receive any interest on the 31st of December as he no longer holds the gilts. Ruth will receive interest on the gilts of £1,500 on the 31st of December as she is now the holder of the gilts, but she will only include £250 as interest income on her tax return, being the interest earned in the 1 month she owned the gilts. Moving on to look at dividend income. Dividends received are also the taxable income amount, but again an allowance is available, which means that some dividends are taxed at 0%. This amount is £2,000, but unlike the personal savings allowance, this £2,000 applies to all taxpayers, regardless of whether they are liable at the basic or higher or additional rates of tax. Dividend income is entered into the income tax computation on the line called Dividend Income and in the column headed up Dividend Income. The final part of this topic is to look at some forms of income which are tax-free or exempt. The main form of exempt income comes from investments made through ISAs. There are two types of ISAs, cash and stocks or shares. Overall, there is a limit which permits a maximum investment during the tax year of £20,000, but this can be split between the two types of ISA in whatever proportion we like. We could put £20,000 into a cash ISA and nothing into a stocks or shares ISA, or £20,000 into a stocks and shares ISA and nothing into a cash one, or we could split it between the two in whatever way. Interest on a cash ISA or dividends on a stocks or shares ISA are exempt from income tax, so in our income tax calculation we don't include this income. Other types of exempt income include prizes, including the lottery and premium bond prizes, national savings certificate interest, and scholarships or educational grants.